Hey, what's up guys? My name is Eric. Welcome to my channel, and today I want to talk about the 30 tips to make a million from the stock market and what it takes to get there. Now for this video, it really is designed for full-time professionals without a financial background on how to invest and whether you want to plan for your retirement in the next 5 to 10 years and you want to accelerate your growth. And if that is you, then this is the perfect video for you to watch all the way till the end. And the first 10 tips is going to focus on investing foundation. The 11th to the 20th tips are going to focus on techniques and some resources I use when it comes to investing. And the final 10 tips are going to focus more on the psychology and some specific scenario like market crash and a bit more about my investing strategy as well. So let's get started. Let's start off with tip number 30. What is the average return for S&P 500? This is important because you know where the baseline is so that you can compare that to yourself and you know whether you're doing better or worse than S&P 500. So the average return for S&P 500 for the last 20 years is 7.45%. Now, if you go search up some other resources, it might be around 8 to 9% return. So if you deduct some management fee, then it's approximately 8%. So if you are currently making a negative return or making a return less than 8% for the last 5 years, then you can immediately improve your return by putting some money in S&P 500. So when you're first starting out investing, it's not always a good idea to manage the entire portfolio by yourself because you might not have the right investing strategy or the complete investing strategy to do so. So that's why you want to start off your foundation with S&P 500 and then manage a portion of that portfolio yourself. So if I go over here to my retirement calculator, how long does it take to actually get to $1 million if you invest in S&P 500? Now, in this case, I assume the return you're getting is around 7% per year, and your monthly savings is around $500 a month. Now, if you are a high-income earner like doctor, engineer, nurses, programmers, construction worker, project manager, you can potentially save more, like $1,000, $2,000 a month. But let's go with $500 a month first. And of course, if you save more, it will just get you there faster. Now for a starting balance, I'm just going to use a round number, 100,000 to start. Now if you're starting with 50,000, 30, 40,000, that is totally fine. You just need to adjust the years for it. Now if you're starting with S&P 500 and you start with 100,000, save 500 a month, this is going to be your year-over-year portfolio balance. And then the second column is the money saved, which is 6,000 a year, very consistent. And a year-over-year gain will increase over time because the portfolio size is increasing. So it will take approximately 27 years in order for you to reach $1 million, assuming you're getting 7% a year. Now, if you're getting anything less than that, then it will take even more time. So it means that in order for you to retire with $1 million, you need to start in your early 30s. And if you didn't do that, then what can you do? Well, you can try to save more, which obviously will help, or you figure out a way to increase your return. So these are really the two variables you can change because you can't change too much about the beginning balance. It is what you have. So if you have less money, let's say $50,000, then it will take you 31 years to get there. So let's say you start with 100,000 and you are saving 500 a month, 7% a year is 27 years to get to $1 million. So that is the baseline. So this brings me to tip number 29. What can you do to improve the 7% return? Now, the natural logical thinking would be to pick some stocks that you think will be growing faster than 7% a year. And I do agree with you. And if you look at historically mutual funds, a lot of them, they actually do not beat the market. And if you look at some of the good mutual funds that are good at picking stocks, they will be getting somewhere around 12 to 15% return. So if we go back to the retirement calculator and use a high return like 12 to 15, it can be achieved simply by picking better stocks that outperform the market. So bringing you back to the retirement calculator, you might be wondering, how did I come up with this 12% return? Now, it really comes from my experience as a CPA. So for the last 8-9 years, I actually work with one of the best mutual funds in Canada. So they have been #1 within their category for many years, like over 15 years. When I talked to them and interviewed them, they said the best return that you want to aim for when it comes to stock selection is around 12%. For some years, you might be able to get 15, but if you're able to get 12% consistently, that's already really good. So in this model, I assume that you're really good at stock selection, you understand fundamental and technical analysis well, and this is how long it would take for you to get to $1 million. So if you scroll down, this is the portfolio balance growth over time. It's 18 years. So it actually drastically reduced the number of years it takes for you to get to $1 million, which is fantastic. And it means that even if you didn't start thinking about planning for retirement early on, you can still plan for retirement when you're 40. So it's not too late. You can still retire by 60 if you are able to start investing, picking some good stocks that gets 12% a year. Tip number 28. Is there anything else we can do to get an even higher return? When it comes to investing, there's something called options or stock options. And based on my experience, it allows you to target 20 to 30% return. So I'll explain more about stock option later in this video in the last 10 tips. This is how you can get an even higher return by using some sort of leverage. I can update the return to 25% return. So usually I put 30, which is fine as well. So let's put 30 for this example. And you can see that within 10 years, you'll be getting to approximately $1 million. So even with $100,000, $500 a month saved, if you are able to get 30% a year, then you can 10 times your account in 10 years. Now, another interesting thing you will note here is that the year-over-year gain is actually quite significant as well. If you are late to planning for your retirement and you need to get a higher return to basically reach your retirement goal, then basically you need a more advanced strategy that, for example, uses stock options or allow you to get a higher return like 20 to 30%. Now, if you look at the year-over-year gain, one of the things you want to consider is how much you want to retire with, whether that is $5,000 a month, $6,000 a month, or $10,000 a month. You just need to look at a year-over-year gain to kind of estimate what is the approximate portfolio value you're aiming for. So for example, if you want to retire with $100,000 a year, then your portfolio value just needs to be around 400 to 500K. And this, you will notice, is a lot lower than the traditional finance retirement approach because the return is higher, so then you need less capital to get there. And this will save you years of investing and waiting and basically accelerate your retirement. So personally, I'm right now at the year 7, year 8 mark. So my portfolio ranges between this 800 to 900,000 mark, depending on the mood of the market. So I think I'm going to be hitting this year 9 and year 10 mark in the next 2-3 years. Tip number 27. So now I want to go through an example when it comes to index investing, stock selection, and using options as well. So here is S&P 500. Now, back in August, September, S&P 500 was around 440. And during the winter time, there was a lot of political tension. Natural gas was in a shortage, and Russia and Ukraine is starting a war. So for those winter months from August all the way to January, February, S&P 500 was pretty much hovering at this 440 level. So basically, if you invested during that time, you would be breaking even. Now, during that period, I worked out that there is a natural gas shortage within Europe and China as well. And that is something I talk about within my program, Investing Accelerator. We looked at specific stocks like oil and gas companies, and we found that Suncor Energy was at a discount. So at that point, it was August, September time, and it was near $18 USD. So we did our fundamental technical analysis, and we found that it is a good opportunity. So I bought around this range. And I held on throughout winter, and I exited near February, if I remember correctly, which is just around here. So now you can see the war further escalated and Suncor Energy actually went all the way up to $38. But just by exiting near January, February alone, the gain is already 44%. So it's going from, let's say, $19 all the way to $27, $28 using stocks. Now, in this case, I'm actually using something called stock options, which further multiply the return. And in this case, I made slightly over 100%. So let me just bring up the broker statement. And here you can see my Suncor position where I put in 20,000 to invest in Suncor Energy, around 24,000 to be exact. And my gain when I exited Suncor is 28,000. So just over 100% return. So that is really the power of A, stock selection, looking at the macroeconomic environment, seeing where the opportunities are, and then use stock options to multiply your return. So hi, my name is Eric Cito, and I'm a CPA. So for the last 12 years, I've been investing in the market, and I tested many different strategies. Initially, I started with day trading, which didn't work out. I tried Forex, which didn't work out. And I even learned programming to test 300 different strategies. And for the last 6 years, when I have figured out my investing strategy, my average return for the last 6 years, up till December 2021, is around 31% per year. So after working as an accountant for the last 8-9 years, I quit my job last year. And I decided to start an investing coaching program to teach people how to invest. So here you will see the screenshots for my portfolio, which I use TD and Interactive Broker. For the 200-something thousand, that is my retirement account, which is RSP and TFSA. So for people in the US, that is actually the equivalent of Roth IRA and IRA accounts. And then on the other side is actually the regular margin account that I have. So together, the average return is 31%. And if you compare that with S&P 500 during the same period from 2016 to 2021, the average is 17%. So I am achieving a higher than S&P 500 return, and my strategy is called long-term stock options and monthly passive income. So for the last 8-9 years where I was working as an accountant in one of the big 4 accounting firms in the world, I have been also working with a lot of different mutual funds and hedge funds as well. So that's how I learned their investing methods. And for the last 3 years, I actually went to Hong Kong to work with different hedge funds to buy companies around the world. So that's like mergers and acquisitions, M&A. So that allowed me to glimpse into their investing strategy. And that's how I also created my own investing strategy by combining that with my testing as well. So on YouTube, I also publish hundreds of videos that I talk about economic news, the latest market crash happening, how to invest and retire, and also the technical analysis templates that you can find on there for free. And I also talk about some of the stock picks, like how you can make $10,000 from this blue chip stock, so on and so forth. So if you haven't subscribed already, then you can click the subscribe button to receive future videos from me as well. So now you know a little bit about me. Let's go back to the 30 tips for investing. Tip number 26. If you do decide to go down the mutual fund and index fund route, what you want is to have a very low expense ratio mutual funds. So some of the mutual funds, they are very expensive, they do a lot of trades, and they are usually not profitable and they're not able to beat the market. So you want a low-cost index fund like S&P 500 that has an expense ratio of less than 1%. So that's kind of what you're aiming for. If it is less than 1%, you can probably give it a pass. And then you would look at the 5-year performance of that fund. If it is better or equal to S&P 500, then it's fine. And because these index funds are generally pretty diversified, you just need to invest in 2 to 3 index funds. That will usually be more than enough. So you don't need to make it too complicated. And this works if you have around 20 to 30 years ahead of you, so then you can invest and save over time. Tip number 25. Now let's talk about something more exciting, which is stock selection. How to pick a great company. The foundation of picking a great company is research. And you need to have the confidence when it comes to investing to hold on to the stock for a long time. Because if you listen to your friend's advice, if you listen to analyst recommendation, they might not have the same strategy as you, and they might not have the same expectation as you when it comes to making a profit. So that's why you need to learn how to do research. If you want to make a higher return, then you do need to put in a little bit more work. So that's where your investing strategy comes in. So what is an efficient versus an inefficient strategy? You can obviously spend hours and hours on the internet reading news articles and not making an investment decision, versus you have a very focused investing approach that helps you get to a decision quickly. So after years of investing, if you are spending more than 10 hours a week on long-term investing, it's too much. So if you master your investing strategy and you are able to automate some parts of it, then generally you should be able to spend around 1 to 2 hours a week on investing. So for myself, when I had a full-time job working as an accountant, 60, 70 hours a week or more, I spent around 2 hours a week on investing. So it's really a matter of doing a little bit of research when I see there is an opportunity, and then making the trade when the timing is right. Tip number 24, focus on having an objective mind. Now, it's very easy to listen to your friend's recommendation, and because they are your friends, you want them to be right. So sometimes you'll skip the research phase and you'll invest immediately. So that's why it is important to do your own research. Back in the day, when I first started investing, I listened to my friend's advice, and he recommended me a junior mining company that was making a loss. But then he told me that Warren Buffett's disciple invested in it, and it is a surefire win. And even if it goes bankrupt, you're going to be making money because the fair value or the intrinsic value is higher than the market price today. So then I invested in the company, and within 2 weeks, the factory caught on fire and it went bankrupt. So in the end, I think the bankruptcy process took years and I never got any money back. So that is an example where I skipped the research process and I trusted my friend. I know he had good intentions, but in the end, I lost money. Tip number 23, focus on the facts. When it comes to investing, there's a lot of rumors, there's a lot of noise, there's a lot of different opinion, people saying something will go up and down. And if you just look at S&P 500, you will see that the bulls and bears always have different opinions. So it's very important for you to focus on the facts when it comes to investing. So that I'm talking about financial statements for financial performance, which is fundamental analysis, technical analysis, which is the historical price and pattern, some news articles where it is based on facts. So then that helps you develop an objective view of the world and the company you're investing in. And you only really want to invest when you're 95% confident in your stock selection. Now, Warren Buffett actually has a very famous rule where he only invests when he's 99% confident, but I think we can be a little bit more lenient and be happy with 95% confidence. So when it comes to making 30% or aiming for 30% return, a lot of people think you need to take on a lot of risk. You need to go invest in penny stocks. You need to go invest in small caps or these new IPO stocks where the opportunities are. But that is not true. And for this tip, it is really about investing in blue chip stocks. Now, if you're just starting out learning investing and you're thinking about penny stocks, small caps, medium cap, don't worry about that. Just focus mastering blue chip stocks alone. That can already get you to 10 to 15%. And then if you're able to learn how to use options and multiply your profit, and then timing your entries better and timing your exits better, then you can get to 30% as well. So when I'm looking at the last 6 years, the companies I've invested in, they are blue chip companies. For example, Starbucks. And you can see that they have a very strong trend. You know that they are a very good company. Southwest Airlines, United Airlines, and then we're looking at FedEx, logistics, shipping company, Suncor Energy, which I mentioned earlier. And these are really big, stable, mature business that they wouldn't easily fail. And if you compare that with the recent market crash in the technology sector, some of the younger, less mature technology companies are actually suffering because they are having great growth in terms of revenue, but they're actually losing money. So then when the bear market comes, it actually hits them super hard and you see drop in value like 50, 60, 70% from the high. So that's why if you are looking to invest aiming for 20-30% return, just focusing on low risk blue chip opportunities will be sufficient at this stage. Tip number 21. Now, if you're just starting to learn investing, I would avoid day trading and short-term trading, because if you're working full-time, it is actually very difficult to do short-term trading because you need to dedicate around 20 to 30 hours or more to day trade. So if you don't have that kind of time commitment, then it's better to stick with medium to long-term investing, where you can think carefully about your investment decision and try to increase your accuracy instead of trying to do a lot of volume. So if you're looking at S&P 500 here, white candles are going up and black candles are going down. So even for S&P 500, where the trend is quite strong, you can see there is quite a number of days that are going down or weeks that are going down, which makes it very volatile. So if you're looking to invest, it is way easier to start with long-term investing and then work yourself from there to improve your investing strategy instead of diving into day trading, where 95% of day traders fail. Personally, I tried day trading as well when I first started, and it's just so time consuming and you get stressed out, and I actually couldn't sleep for many nights because my orders were opened and I was trading Forex at that time, so the market was open 24 hours. So I wasn't getting good quality sleep. My school during that time was suffering and I wasn't getting really good results, and it actually hurts my relationship as well. So if you can, don't do short-term trading, stick with long-term, and you will be a lot happier. So tip number 20, in between growth stocks and discounted stocks, I always focus on discounted stocks. Now, when it comes to growth stocks, it seems very sexy, it is the future, and everyone wants to jump in on it. So a lot of times when you're investing in growth stocks, you need to pay a premium because there's a lot of hype and momentum. When it comes to discounted stocks, it is less sexy, but then you get more protection. So in an environment like the bear market, then you want to invest in discounted stocks and you want to learn how to find them. So let me just give you a couple of examples of growth stocks that suffered a lot during the recent bear market because they are now out of favor. So one of them is Zoom Technology. So here you can see that for Zoom Technology, it is a conferencing company and they have this software that allow people to work from home. So they went from a very low share price all the way up to $575. And then you can see it come crashing down since October 2020. So if you invested anywhere from here onwards, you would be losing money. And there's a very slim chance or a very difficult one for it to recover because the momentum is gone. People who are going to cash out, they cash out already, and it's going to take years before Zoom Technology will come back. Now, another one is Moderna. Now, this is one of the vaccine stocks where they make the Moderna vaccine, and you can see that historically the share price is extremely low, and it rides the wave all the way to 475, but because now we don't need the vaccine as much, like everyone who's going to get the vaccine is going to get the vaccine, it actually dropped around more than 50% of the value. And even though the company itself is strong, they have a very important technology to our world, but because it is out of favor and biomedical stocks are kind of going down at the moment, you can see the drop is quite significant. So that's why if you are investing premium stocks, like premium growth stocks, this might happen anytime. So then you're not getting that protection. So that's why even if I'm aiming for 30% return, I focus on discounted stocks because we start by finding low risk opportunities and then we figure out how to use options to multiply our return. So you might be wondering, does this strategy work for other people? So let me introduce you to a couple of people who have learned this investing strategy and made a good return for themselves. So the first one is Mary. She's an accountant in Sydney, Australia. And before she started investing, she used to invest in her own savings account, making 0 to 1% in terms of interest. And after she learned investing, she invested in her favorite company, Aritzia, a growing Canadian clothing company. So the ladies on this webinar will know what that is, making 42% in 18 months. And last time I checked with her, she's still holding on to Aritzia. Stacy, she's a consultant in San Francisco, and she used to invest in UK bonds, making only 1 to 2% a year. And after she learned investing, she made 33% from Starbucks in 4 months and 40% from Disney in 11 months. So you can check out her testimonial on my website as well. The next one is Carolyn. She's a controller in Vancouver. Previously, she was making less than 2% from day trading with inconsistent results. And after she learned long-term investing, combining technical and fundamentals together, she made 79% from Facebook in 7 months and 90% from Intel in 5 months. So you might be wondering, what if you have zero financial background? And the previous 3 people all had some sort of financial background, so the next 3 has no financial background. So the first one is John. He works in the government in the United States, and previously he followed US analyst advice and lost money while entering at a high. And after he learned investing, he made 57% from Dollar Tree in 5 months using stock option. And John is also a real estate investor, so he's really using stocks as a way to diversify his real estate portfolio, so then it is more balanced over the long term. The next one is Benson, and he's an engineer in Vancouver, Canada, and he used to invest in mutual funds that gives him 5% return. And after he learned investing, he invested in Shake Shack, one of his favorite burger companies, and made 90% in 4 months using stock options. And he also made 100% from AMD without using stock options as well. And he's the second student in my program that made over 100%. So you can see his testimonial on my website as well. And finally, Lee. She's a data analyst in Texas, Austin. And she lost $40,000 back in 1990s, and she lost her confidence to invest. And after she learned how to invest, she made 65% from Activision and Blizzard in 5 months using stock options, and she made 125% from Nvidia in 5 months using stock options as well. And she's the 4th student within my program to make over 100% from a single investment. So it is possible to learn investing even if you don't have a financial background, even if you are working a full-time job. For the last 4 years, I've been coaching people on investing, and so far, there's 677 successful exits within Investing Accelerator. 138 students made over 30% from their first investment, and 37 students made over 100% from a single investment. And within the program, some students also decide to be a hedge fund manager as well. So right now, 2 students already started their own hedge fund, and 1 student is looking to start his own hedge fund as well. So these are the stats to date, and if you look at my website, they're probably updated by now, so they're increasing over time, which is great. So the first 10 tips, we talked about some of the foundation, understanding of investing, how to avoid some of the major mistakes when it comes to investing. Now for the next 10 tips, which is 19th to 10, I want to share some of the resources I use in Investing Accelerator, and most of the tools I use are free. And I don't rely on any analyst recommendation because we focus on having an objective mind and come to our own conclusions. And there's a lot of free information on the internet, so it's a matter of learning how to use these tools and knowing where to find them, so then you can grab that information as quickly as possible to make the correct investment decision. So number 19, so this chart you see right here is a website called TradingView.com. Now I'm not affiliated with this website, but this is one of my favorite websites when it comes to technical analysis. It's quite comprehensive, so I'm going to show you how you can set this up and get it for free. And what you do is you go to TradingView.com, and then you're going to arrive at this page. Now, if you zoom in here on the right upper corner, then you'll see Get Started, which you can't barely see from the screen, but just click on it, and this will bring you to the pricing table. So they used to have the basic version here as well, and then Pro, Pro Plus, and Premium. But if you scroll down a little bit, then you'll see need something a little simpler, and you can try free basic. And if you do that, then you'll be able to register an account for free without putting in your credit card. Now, I do teach how to set up the charts exactly like mine in another video on my channel, so you can subscribe and watch that video. So I wouldn't be able to go through everything with you here, but sign up with your email and then afterwards log in. So once you got your free account, then you can go back to the main page, which looks like this. Now there's a lot of things going on in this page, but I just want you to focus on the chart. So on the upper left here, you can click on chart, And this will bring you to your standard TradingView chart. So let me move myself on the left side, and let's say we go to S&P 500, SPY. And here you can see that I already have some indicator set up already. So let me just delete that. And what you want to do is really clean up this chart so then it doesn't have any indicators on it. If you have some indicators at the bottom, delete that as well. And if next tip I want to give you is which time frame to use. So when you are thinking about long-term investing, you can see that you can choose a time frame like 1 minute, 5 minutes, 30 minutes, 1 hour, 1 day, all the way to 1 week and 1 month. And if you plan to be a long-term investor, then I would suggest you to use a weekly chart and nothing lower than that. Because the shorter the time frame you use, the more noise you will encounter. So then in Investing Accelerator, I teach people to use a weekly chart. And this will give you a lot more time to think. The market will also go a lot slower. So then you will be able to plan your entry a lot better and plan your exits a lot better as well. So stick with the weekly chart, and that will help you filter out a lot of the false signals as well. For tip number 17, I want to walk you through and help you add one of my favorite indicators, the Bollinger Band. Now, if you remember your statistics class back 10, 20 years ago, there is the concept of a bell curve in statistics. So basically, within what we call 2 standard deviation of the bell curve, 95% of the data points will be within it. So anything outside of 2 standard deviation of the bell curve is considered to be extreme and outliers. So how do you add this indicator that helps you automatically calculate what is this boundary so then you can find extreme prices where you can enter or exit? So you go up here and click on indicator, and then you type Bollinger Band. So BOLL, and then it should show up already. And then it's this one, the Bollinger Band. So if you click on it, then you will see that it shows up already. The default is 20, which means 20 data points. And since we're using the weekly chart, is 20 weeks. So what you want to observe here is that every time the Bollinger Band is close to the price, it is usually an extreme price. So if you're looking at, let's say, S&P 500 right now, you'll see that prices has been touching the lower parts of the Bollinger Band. So this can potentially be an opportunity where you enter at a discounted price, and you'll see that when it touches the lower parts of the Bollinger Band, it usually bounces back up. When it comes to the next tip is about candlestick. So this is one of the price patterns that I look for, and it's actually quite a strong signal when you observe them. So what you will see is that this is called a pin bar. So this is one of the candlestick patterns, and there's like hundreds of different combinations and patterns as well. And I find that this is one of the more reliable ones. So what you're looking for is on the right-hand side called a bullish pin bar. So what you see is a very, very small box, and usually when the week open at that price, it usually ends up near that price as well. And what you'll see is a very long wick, which represents that initially during that week, there's a lot of sellers that push the price down, and then a lot of buyers coming back in to bring the price back up. So there's a very high range within a week. So the open and the close price, it's around the same. So if you combine this with the Bollinger Band technique I taught you earlier, then it becomes very powerful. So for example, if you go back to S&P 500, you're not going to see a pin bar every single time, but the occasions that you see it, it will be very helpful to you to analyze them. So for example, September 2019, you can see there is a pin bar here where there's a very long wick. And then afterwards, you can see the market goes up. And this is near the middle to bottom parts of the Bollinger Band, which gives you further confidence. So you see how I'm combining both of them together. And earlier in August, you also see that these are not as perfect in terms of pin bar, but they're near the lower parts of the Bollinger Band, and they are exhibiting that symptom where you can see that there is that wick, the body itself is small, and then afterwards it's going up. So the markets does give you indication on when it is a good time to buy, and these are 2 of the techniques you'll learn in Investing Accelerator to help you better time the markets when it comes to entry. So the next tip is really about what should you do when you see the price reaching the lower parts of the Bollinger Band, or you see a pin bar near the Bollinger Band as well. So at that point, you don't enter immediately. You need to do further analysis. So within Investing Accelerator, some of the analysis we also go through is additional technical analysis, fundamental analysis, meaning we read the financial statements of the company and we combine that with news and other analysis I teach within Investing Accelerator to make sure that we're getting in at a good discount and this is a good company and everything else checks out. So then we understand the risk, like the macroeconomic environment, so on and so forth. And if you use what I just taught you, the Bollinger Band, the pin bar, as a starting point, this will actually save you a lot of time, filtering through all these other companies that are not at a discount or they are not ready yet. So once you have that beginning part, a lot of the other analysis you do will be a lot easier and it will make a lot more sense. And this will drive your confidence because you're building your analysis on facts and it is very objective. So you're learning more about technical analysis on YouTube or on the internet, you'll find that there are hundreds of different kind of combinations. So you can see that just clicking on indicator, it will show up like a lot of indicators and people develop their custom owned indicators as well. 10 years ago, when I first started investing, I started with technical analysis and I tested over 100 different strategies I find on the internet and most of them, they don't work. And it simply makes the chart more confusing and less clear. So then, for example, like you might be using RSI, you might be using MACD, which is moving average convergence divergence. So then you can add a lot of things onto your chart, but then it doesn't necessarily make the signal more clear. So that's why you need to develop very clear rules for you to use. And let me just add another one so that you can see. So you can see that your chart is quickly becoming more cluttered. So you want to keep a very clean chart when you're doing analysis, so then you can reach a decision very quickly. So mainly it saves you time because if you're working full time, like I was, then you want to be very efficient, spending like maybe 1 to 2 hours a week on investing, and that's pretty much it. So you want to declutter your chart, delete any analysis that is providing you with the same information. So delete any duplicated analysis. For the next couple of tips, I want to introduce you to some of the resources I use in addition to technical analysis. So when you think about technical analysis, it's only really a small part of my overall analysis. So as a CPA, I always look at the financial statements. It is crucial when it comes to investing. And the first website I use is marketwatch.com. So you can see that website here. And then you can search up your favorite company. It's mainly US focused. So if you go down here and click on financials, then you would want to analyze the income statement, balance sheet, and cash flow. So those are the minimum you need in order to analyze the company. So what you're looking for is really the growth, any problems you encounter, then you need to go dive into the financial statements and dig deeper. The next tip is the other website I use in addition to marketwatch.com, which is investing.com. Now for MarketWatch, it's a very US focused website. So it's not very complete when it comes to other countries' stocks. So then if you're looking for Australian related or Hong Kong, I think they have it as well, Canada, then you would want to use investing.com. And if you, let's say, pick Air Canada, one of the things I like about investing.com is that they actually have the ratios analysis. So you probably have heard or used the PE ratio or other ratios as well. And most people, they only use PE ratios and they don't have a very strong understanding of the ratios. So that's why in investing.com, they actually give you all the ratios. So PE, PS, P cash flow, free cash flow, book, and tangible book as well. And each of them mean different things. So for Air Canada, you see here, they actually didn't calculate all the ratios. So let me just pull up another example like Disney. So here I jumped over to Disney's ratio analysis. And here you can see that they calculated all the ratios for you. So then if you want to do your ratio analysis, this is very convenient and it will save you a lot of time. So the next resource I want to introduce you to is Options Profit Calculator. And if you're looking to learn options and learn how to multiply your return and employ different strategies, then this is a pretty comprehensive website that I think will be helpful to you. And you can see that there are, the basic, the spreads, and also advanced as well. Now, within Investing Accelerator, I do develop and create my own option calculator. So the students within the program will have access to that automatically. But if you don't have access to that yet, then you can use the Options Profits Calculator as well. So for example, if you choose long call and you choose something like Disney, and then you can choose the option that you want, which is, let's say we choose June 3rd. I just pick a random strike price for illustration purposes and click calculate. Then what it will show you is all of the percentage changes and how the dollar value changes over time from May to June and based on price as well. So if it goes up or down. So then you can easily see, what is the time decay, like how profitable are you going to be. So if you want to make 30%, then you can use the option profits calculator as a guidance. Within Investing Accelerator, there is a simpler calculation to figure out your target exit price to make 30% return, but this is another approach to it. So throughout this video, you hear that I talk about Investing Accelerator for a couple of times. So I just want to quickly introduce you to my coaching program. What is Investing Accelerator and what is included in it? So for Investing Accelerator, I focus on helping full-time professionals without a financial background on how to invest and how to manage your own portfolio with confidence. So there are two strategies you'll learn in there. So the first one is long-term stock options, and the second one is monthly passive income. So the target for both strategies is to aim for a 30% return. For long-term stock options, it works with retirement accounts like IRA, Roth IRA, RRSP, TFSA. And it is long-term focused, it is more passive, but it is volatile. The second one is monthly passive income. And this is when you are approaching the retirement age, whether it's 60 or 65, or if you want to retire earlier, and you want to create a more predictable cash flow. So the target is still 30% return, and the goal here is to get 3% a month using options to generate interest income. So the tax will be different, and you will usually need to use a regular account for it. There are three parts to Investing Accelerator. So the first part is online video lessons. The second part is weekly group coaching calls. And the third part is private Facebook community. So when you join the program, you'll first go through the online video lessons. So that's where I talk about the entire investing strategy, and you'll learn it within 4 to 6 weeks, 4 hours a week. And after that, you'll be ready to find your first investment. And at that point, you just need to budget around 1 to 2 hours a week to manage your portfolio. Then that's probably sufficient. And if you have an idea, then you can send your stock pick to me, and I'll analyze it during the weekly group coaching call. If you don't have a stock idea, then every week I'll also gather the stock picks from myself and other students in the community as well. So if you don't have an idea, then watching the latest weekly group coaching call will give you the latest ideas. And if you feel confident, then you can invest as well. Every time I'm investing, whether I'm buying or selling, I'll also send you an email on exactly what I'm buying, selling, which option I'm using as well. So then if you want to follow me, then yes, of course, you can follow me as well. And as you go through the program, if you have any questions, you can ask me on WhatsApp or email as well. So I usually get back to you quite quickly. And for the Facebook community, that is really a platform that allows you to interact with other students in the program, and you can see what they're investing in as well. So it's a pretty active platform, and we do talk about a lot of the latest events, like how to deal with them, like interest rate increase. So we do cover a wide variety of macroeconomic and also company-specific events within the community as well. So that's a brief overview of Investing Accelerator. So if you're interested in being part of the program, then in the description below, you can schedule a call with me, and I can answer any questions you have and talk more about the program and take a look at your portfolio as well. So because of the high volume of the call, it'll be either myself, Eric, or it'll be my assistant as well. So you can click on the link below and schedule a call when you are ready. So now we'll go forward to the last 10 tips. So tip number 10, dealing with fear. So when you're investing, it is very easy to feel scared, especially you have lost money in the past. So that's why you need to root your foundation or your analysis in research. So for example, if you are investing in high-risk companies that are losing money, and during this market crash in 2021 and 2022, you'll probably witness how crazy the market can be when you see high-tech stocks going down 80-90% value. And if you want to be not scared, then you need to invest in safer companies. So for example, I currently have a Microsoft holding. Now, Microsoft is a blue chip company, it's pretty safe. You wouldn't be as scared if you are investing in Microsoft. And it's just a matter of price, how you can get in at a discount, and looking at the overall macroeconomic environment to make sure everything checks out. So that is a complete change in terms of mindset and it helps you to become more confident when you are investing as well. So tip number 9, how much money should you start investing with? Now, obviously, this depends on the total portfolio balance you have and how much experience you have as well. Some people, they're confident to invest 100% of their money themselves, like myself, and you don't need to invest in any mutual funds or index funds at all. But if you are a complete beginner and you have no experience and you're just testing this out, then I would say 80% of your portfolio should be in index funds or mutual funds, and just allocate around 20% or 30% of your portfolio that you manage yourself. So if you're investing 100K, just put 80K in index funds first, so then that can grow for you at a slower pace, but then you don't need to worry about it. And then manage 20 to 30K yourself, so then you can try out different things and try to get a higher return. Once you master your investing strategy, then you'll be a lot more confident, and you'll also have a much stronger feeling on how much you want to manage. So some people, they can get comfortable very easily and manage the entire portfolio themselves. Some people, they want to be conservative and they just want to manage a portion to reach their retirement goal. So the next tip is about your retirement goals. So most people I work with, they want to retire within the next 5 to 10 years, or you are retired already and you want an extra boost in income. So how much capital do you actually want to manage versus letting someone else manage it? So here is the calculation I made. Now, if you're using a more aggressive strategy and aim for a 20 to 30% return, then that allows you to use a lot less capital to achieve that result. So for example, most people I talk with, they can retire with around $5,000 a month to $10,000 a month. So what you're really looking at in this chart is the portfolio balance in the first column. And the money you save, let's say, is $1,000 or $500 a month. In this case, I put in $1,000 a month. And the year-over-year gain. So you want the year-over-year gain to be around $50,000 to $100,000. And if you're starting with $100,000, saving $1,000 a month, then you'll probably reach that within 3 to 5 years, assuming you get 30% per year. And you'll realize that this balance is actually a lot lower than traditional finance, because they assume that you only take out 4% of your portfolio, whereas here I assume you have a 30% growth rate. So the growth rate is really the key to reduce the amount of capital you need to invest and need to save in order for retirement. And if you are aiming for a more ambitious and luxurious retirement, then some people, they might be aiming for 10K or 20K a month. Then this is where you need to have a larger portfolio balance. Like for example, down here, year 10, where you're aiming for like a 2 million portfolio, and then your year-over-year gain is like 400K. So perhaps this is when you're living in New York and that is the lifestyle you want. Tip number 7, when you're investing, you want to follow one investing strategy. So personally, I tested over 300 different strategies, and I even learned programming to test different strategies. A lot of them don't work, but once you find a mentor that you trust and you like, follow one strategy until you master it. Because if you start putting a lot of different strategies together, the philosophy of each of the strategies are different. So that they actually conflict with each other, and you need to match the risk management strategy, combining with entry and exit, research, and how you think about the market. All of them need to work together. So if you put a lot of different strategies together, it is actually a little bit counterproductive because it's not going to work together. That's why you need to have one strategy all the way till the end and focus on mastering that first. So in terms of the formats of Investing Accelerator, it is a lifetime membership. And the reason why I structured that way is that when you learn the strategy, you will have a lot of questions. And then after that, it's just a matter of stop picks, entry, and exit. So that's why it is a lifetime membership. So once you go through the learning curve, then you will enjoy the benefits, like the weekly group coaching call, for many weeks or months to come. So if you're interested in being part of the program, then you can go to the description and click on the link to schedule a call with myself or my team. And it is a 45-minute call, and we'll look at your portfolio. You can ask me any questions you have. And we'll also talk about your goals, like retirement goals, or what you're trying to achieve with your portfolio in the next 5 to 10 years. So it'll be quite a valuable call. So if you're interested, then you can go to the description and click on the link to schedule a call with me. And you will be prompted with a survey, so you can fill that out. And I'll review all the surveys before the call so then you get my feedback in the most prepared manner. Before we dive into the last 5 tips, I want to share 3 student videos with you on how they master investing and their experience with it. So the first one is Mike. He's a doctor in Indiana, and he's one of my most successful students in the program. And after he learned investing, he made 100% from ARMK.
Hello everybody, my name is Mike and I am from Indiana. I work as a physician. Before joining Investing Accelerator, I've traded in stocks and options for at least several years. The demands of my time for work as a doctor as well as for my family and other things have limited my ability to take advantage of the stock market, especially with trading options. I discovered Eric's Investing Accelerator online, and after confirming the program, I decided to join. Since joining in mid-February of 2020, I was able to invest in some stocks using his teachings. One of them is Aramark with a stock tick of ARMK. I entered the trade for this stock on March 20th and exited on April 9th. In less than a month, I was able to get 100% return of my investment. I'm very happy upon discovering this program, and through his teachings, it's enabled me to be more confident in investing in the stock market, and now I'm able to have less time and effort in assessing any stock. My one piece of advice for anybody who's interested in joining the program is to take your time to learn each part of the program and also take time to listen to Eric's weekly coaching calls. I rate this program as 5 stars over 5. And with that said, thank you, Eric, and I wish everybody the best.
The second student is Peter from Australia, and he's actually a nurse with no financial background as well. And his first investments are 69% from Activision in 1 year, and Intel 35% in 1 year as well.
Hello, my name is Peter. I live in Brisbane, Australia, and in March, April of last year, 2019, I met up with Eric from 5 Minute Investing. I got to know his approach and style to investing, which I really liked a lot. And so I went ahead and joined his training program. In May 29 of 2019, I purchased my first bundle of shares on the US market, the ATVI, Activision Blizzard, and I paid $43.41 per share. I bought 400 of them. That cost me $17,364. So now they're worth $73.08 a share, which has given me a gain of $11,868. And I plan to hold on to these till they reach about $75, which is not far away actually. And then also, not long after that purchase, in June of 2019, I bought 500 shares in Intel Corporation. I paid $46.73, and that cost me $23,365. Now they're trading at $62.26. Today's date is the 22nd of May 2020, and that's I'm going to hold on to these until they reach around $65, which is not far away either. So I'm really happy with that. Then this year, on January the 29th, I purchased 200 shares of Shake Shack for $67.60, January 2020. after January, in March, we had a big drop in the market. I saw an opportunity and I bought another 200 of those shares of Shake Shack for $35.04. That was on April the 2nd. So my average cost for the whole 400 shares was $51.32. So as of today, the 22nd of May, they're now trading at $52.45 a share. So I've made a small gain of $452. I'm not concerned about the market dropping like it did, because we look at the company, we look at its financials, we look at its balance sheet, and no matter what's happening, if you buy well, you'll do well, and the plan is to buy and hold for medium to long term. So I'm going to hold on to these shares until they reach around $70, and I might sell half of those. Then also on the 4th of April this year, after the market drop, I purchased 200 shares in TEK, a big mining industrial company that have been trading way higher than the price I paid for them, which was $7.38 on the 4th of April. Now today's date, they've already moved up. They're trading at $9.16, which has given me a small gain of $356. I plan to hold these also till about they reach around $20 to $25. That'll give me 3 times back the money that I've spent on the purchase price. So overall, I'm quite happy, very happy, considering the amount of work that I've put into doing this. After actually doing the research and investigating, you just basically watch what happens. And so I've a total paid out of all my shares a cost of $62,733. That's what it's all cost me. Currently, they're all valued. If I sold them all off today, I'd get back $83,174. So if you work that out, it's well over 30% return on your money. And I reckon that's a great return, considering I didn't use options to do any leverage, which I will do in the future anyway. But this is just purely on buy and hold and let them go back up. So overall, I'm really happy. I'm impressed with Eric's knowledge, his approach, very conservative. This is not a high risk business we're in. We're in a very conservative, low risk, preserve your money and see it grow. And that's what I like about it. You only get one chance at this in your life. You don't want to end up losing everything. But this is very, very good strategy, and I'd recommend anybody who wants to invest wisely in the market to have a look at Eric's program. He's a great guy. He's got time for you, and I've made a friend out of Eric. Thank you.
And the next one is Adrian. He's from Vancouver, Canada, and he works in the government. So his first investment is FILR, 45% in 1 month, and GLW, 128% in 4 months.
Hello, my name is Adrian. I'm from Vancouver, Canada, and I currently work for the government. Before joining Investing Accelerator, I was a rather risk-averse investor who mainly invested in mutual funds and ETFs. I felt that I did not have the knowledge, confidence, and motivation to step foot into the stock market. However, I previously worked in the aviation industry and have a science background, and so I have a considerable amount of knowledge of the aviation, and I wanted to use that knowledge to my advantage. But I didn't have the knowledge to understand the financial situation of companies that I was interested in. Neither did I have the confidence to make my first trade because I didn't have a sound and cohesive strategy. This is where Eric's program, Investing Accelerator, was able to help me. His program gave me the knowledge to understand the financial health of a company, to understand the considerations when picking a company, and also to understand the timing of a trade. With that knowledge, I became confident and made my first investment, one of which was in FLIR. FLIR, an acronym for Forward-Looking Infrared, the same technology that the company is founded on, is a company that specializes in thermal imaging sensors and cameras. I understood that there was growing demand worldwide from governments, airports, supermarkets, hospitals, etc., for thermal imaging cameras to screen for people, and with the fundamental analysis done, I was confident to put my money in. In April 2020, I made my trade using only stocks, and in just 28 days, I cashed out for a 45% gain. That translates to roughly $2,500 US for me. Now, let that sink in a little bit. 45% in just under a month. That's pretty incredible for me, at least. It doesn't stop there. In the same month, I also invested into a company called Corning with call options. Prior to joining Investing Accelerator, I had not a single clue what an option was. 4 months later into this investment, I netted a 128% gain for $10,000 US. I understood Corning as an industrial giant that produces specialty glass, like glass found in motor vehicles, spacecraft, cell phone screens, fiber optic cables, and laboratories. With my understanding of the business, in addition to the newly gained knowledge and skills gained through Investing Accelerator, I was able to identify Corning as a worthy investment. Now, I fully realize the potential of my money. My savings will finally grow, and it is about time that my money started working for me. I was looking to buy property for myself to live in, and for those of you who are not aware, Vancouver has some of the most overpriced property values in the world. Now that goal of property ownership suddenly seems much more achievable, much sooner than if I had not taken advantage of Eric's program, Investing Accelerator, and of course his continued support and guidance. If there is one regret, it is the fact that I didn't take Investing Accelerator any sooner. I'm only 5 months into the program, and I can give it a full 5 out of 5. I'm looking forward to seeing my next profit, and I feel very confident that the knowledge I gained through Investing Accelerator, and just as importantly, Eric's continued support and guidance, will help me achieve that profit. A nice vacation, a round-trip flight on business class, and staying at a 5-star hotel, well, once the pandemic is over, of course, does seem like a reasonable reward after doing the homework, don't you think? If you're watching my testimonial and thinking of joining Investing Accelerator, just know that I was probably once in your shoes. I'm quite skeptical as a person, so I wasn't sure if I should have taken the plunge and joined at all. But I watched all of Eric's YouTube videos before I finally did take the plunge. And if you haven't watched any of his videos, I really implore you to do so, as you will get a very good taste of what you'll learn in the full program.
Tip number 5. So now we're really down to the last 5 tips. So, thank you for watching this video, and I'm very excited to share these 30 tips with you. So let's go through the last 5 tips together. So what is a black swan event? So black swan event is an unpredictable event that is beyond what is normally expected. So basically, a negative surprise. So in the stock market, there are a lot of these black swan events. So if you are investing and you encounter these black swan events and you have the stock, you should get rid of them for now and re-enter once the black swan event is over. So within Investing Accelerator, we always look at market crash and a different reason and how the market usually crash. And we take advantage of these black swan events because we think that's where the discounted opportunities will be. So when you're investing, it does require a lot of patience because you're waiting for these black swan events to happen. Tip number 4, let's talk about options. When you are using options within my program, which is long-term stock options mostly, what can you expect in terms of return? So if the stock goes up by 10%, then the option would go up by 20%, which is approximately 2 times. So that is a really good rule of thumb to remember when you're investing using options. Of course, there are more aggressive strategies out there, but that is a good rule of thumb to follow without going through all the math like the Black-Scholes model. Tip number 3, hedging. So when you're investing in a bull market, hedging is usually not needed. But when you're in a bear market, or when you think there's some sort of unexpected negative events that will happen, and you want to reduce that risk, then that's when you want to use hedging. So within the program, I do teach hedging and how to use that for our protection. So for example, one of the stocks that we're currently investing in is Disney. So when we look at Disney, it was already at a discounted price, but then we predicted that there's going to be some additional bad events that happen to it. So then we entered into a hedge. So that is the use of a put option to reduce our risk. So then afterwards, Disney dropped more, and the hedge itself gained around 46% within the span of 1 month. So then we take the profits on the hedge, and we use that profit made to average down on our Disney position. So that's how we would use hedge to reduce our risk when it comes to investing. Tip number 2, risk management. So when you're thinking about risk management, there are many variations of it, like using stop loss, using some sort of research methodology, diversification. What's important for you to understand about risk management is that you're not trying to take the maximum risk to get the maximum reward. What you're trying to do is to take the minimum amount of risk to get the maximum reward. That's why as you go through this video, you'll see that I reiterate that we focus on blue chip, safe companies at a discounted price. So within the research methodology of Investing Accelerator, we focus on lowering our risk every step of the way. And it's only once we find a very low risk opportunity, then we'll use options and other strategies to multiply our profit. So without low risk opportunities, it's really difficult to invest because you're going to be wrong a lot and you will lose money a lot without proper risk management. And tip number 1, for my strategy, it is called long-term stock options and monthly passive income. And you need these 2 strategies because when you're investing long-term, you get a lower tax rate. You can use it in your retirement account up until 59.5, or in Canada, whenever you want to take it out in RRSP, then you get taxed. And then when you get closer to retirement, you need monthly passive income. So you need some sort of cash flow generating strategy as well. And this will get taxed as short-term capital gain in US, which is kind of like a salary. And in Canada, it will get taxed like a salary as well. But if you're planning for your retirement within the next 5, 10, 15 years, you need to master both strategies. And the reason is because if you only have the long-term strategy, then your portfolio itself is very volatile and it doesn't give you the comfort to sleep at night and retire. If you only have the monthly passive income strategy, then during the accumulation phase, the buildup will be a little bit slower because the tax rate is higher. So then if you do that, then you're not growing as quickly. So you're not reaching the goal as quickly as you should be. So that's why you need to have both strategies. And over time, you want to allocate more from your long-term to the monthly passive income until you reach your desired monthly income goal, and then you can retire. So thank you for watching the entire video, 30 tips for investing. And if you are interested in being part of Investing Accelerator, then you can go to the description and schedule a call with myself and my team. So there's limited amounts of spots, so you can find a time that works for you in the next 7 days, and then I'll send you an email to request some additional information on your investing strategy, how you're investing, to identify if there are any opportunities for you to improve as well. So if that's something you're interested in, then you can go to the bottom of the video and schedule a call with me now. So thanks for coming, and I'll see you in the next video.